Welcome back to the Well Off Podcast. It's George Almastri, and on this episode, I interviewed Clienta and Jude from the Fergo group, and we discussed how they got started in real estate. They actually started off by buying single family and duplex properties and have recently been purchasing apartment buildings in a very short period of time. So their story is pretty incredible considering where they've come from, how young they are. We talked about like their current projects. So they have a 25 unit mixed use building that they've just acquired. They also talked about self-managing their Windsor portfolio, and they talked a little bit about their properties in Sarnia as well. So they have, like I mentioned, a couple of apartment buildings, and the way that they've scaled is really impressive. They also talked about how they acquire these buildings, some of the creative financing, these types of things. So I think you guys are going to enjoy it if you are interested in apartment buildings. And if you do like this, then please do share it with somebody you know, a friend, a family member, anyone who's interested in real estate investing. And then if you can leave us a 5-star review, that would be greatly appreciated. So thank you for all your support. And here you go. All right, I'm here with Jude and Clienta. This is the first time we have you on the show. I know you guys have done a lot of other podcasts in the past, but I appreciate your time. I think you're both currently in Windsor. Is that right?
Yes, both in
Okay,
Windsor.
cool. So I just normally start off by asking about where you guys grew up and just a couple memories. So if you can each just share that quickly.
Yeah, so I'm born and raised in Mississauga, Ontario. Just grew up normal middle class family, and then kind of now we decided to move out to Windsor to pursue our business and our kind of company.
Yeah, and then a little bit about myself. So I was born and raised in Dubai. I moved here when I was 12 years old with my family, and same thing, middle class family. My parents actually are both real estate agents, so they kind of opened my eyes into the real estate world and what working for yourself can look like. So that was a good introduction, and then obviously me getting my license and going from there.
Cool. I didn't know you were raised in Dubai. What was
Yeah,
that?
those were.
What was that like?
Well, a lot of people think that I had a lot of fun, but it actually was not that much fun because I was a student
Yeah.
and the schooling there is a lot harder than it is here. So I
Uh-huh.
remember when we moved to Canada, my parents would say that it was like a piece of cake every day for me. Like I was going to
Yeah.
school and it was just fun, right? So, yeah.
Yeah, so I'm Lebanese and I have
Oh,
like
nice.
some friends that I guess they either moved there after being in Canada for a bit, the kids like moved there and studied, and then when they came back, I have a friend that actually skipped a grade or two maybe, I can't remember because it's so much more advanced there.
Yep.
Or I don't know if it's more advanced. Maybe it's
It's
just
just
harder.
harder when you're
Yeah.
younger, right?
Yeah.
Like here they kind of front loaded once you get into university,
Yeah.
whereas they're like right from like elementary school, they're teaching you things that are really advanced so that
Right.
when you get to that university level, like it doesn't feel like a complete shock.
Yeah. Yeah.
So,
So you
yeah.
never skipped a grade. You just kind of went with the
No, I
system.
never skipped a grade.
Yeah.
No, I never skipped a
Yeah. Yeah.
grade. Yeah, but
Cool.
my parents also planned it where they knew that finishing that school and when this semester would start, because in
Mhm.
Dubai it's a little bit different when you start and end school. So
Yeah.
they made it so that I would come for this new year in my new grade.
Right. And you were bored
Yeah.
at school for the most part over
Yeah, I
here?
was pretty bored. In
Yeah.
elementary school, I was really
Yeah,
bored.
yeah.
Yeah.
Cool. So how did you guys meet?
We actually met in high school. Like we
Yeah.
both kind of were in the same different high schools, but in the same tutoring program. So
Right.
like in grade 12 and grade 11, you go to this tutor to help you kind of basically get to university. I
Mhm.
wasn't the best student in high school, so I had to basically take extra classes to kind of learn supplementary to kind of boost my way up to to get to university. And we were both studying to become or trying to get into school for engineering.
Mhm.
So essentially we both met through there, and then we started dating in university, actually.
Okay, cool.
Yeah.
And you guys is it the same background? Like you guys are your parents are immigrated from the same country or something like that or?
Yeah,
Yeah.
like we're
I
both
mean, yes and
originally,
no. Yes and
yeah,
no. Yeah.
Yeah.
we're both originally like our parents are originally from Goa in India. My
Okay.
parents immigrated from Pakistan, Karachi, and
Uh-huh.
they just lived there, were born there, but we're both have the same kind of background.
Oh, okay. Okay,
Yeah.
cool.
Yeah.
Yeah, and I didn't know like we've had a chance to speak a little bit in the past, but I didn't know
Yeah.
all these details. All right, so let's get into what I guess people want to hear about, which is like how you guys got started in real estate and just a little bit about your journey.
Yeah, I think like basically we like I said we were both in school for engineering. We before that we were both very ambitious growing up. We had our own individual side hustles and businesses. I was in, doing landscaping, shoveling snow, mowing lawns, delivering newspapers, all these kind of random side hustles since I was like 9 years old, all the way up to my teens. And Cleantha can talk a little bit about
Yeah,
her.
I worked as a lifeguard, swim instructor. So I used to be a competitive swimmer, so I got into it that way, talking like dealing with instructing. And then I got my lifeguarding license, did that. And then during COVID and like during high school as well, working at like warehouses, just trying to make as much as I could in that short period of time and also alongside of school. So it kind of worked well in the warehouses because I would do the night shifts. So basically, it would be like 6 p.m. to 5 a.m. and then sleep a couple hours and then do my schooling. But it was online schooling because of COVID. So it was a little bit easier to manage. And yeah, just trying to save as much as we could. And then Jude was into like stocks, if you want to touch base on that and like,
Yeah, for whatever reason, I think we both had, like, even before we met, we had both very entrepreneurial mindsets. Not that we had any like family or anything in the entrepreneur space, but we were just like naturally in our blood, just trying to be something, be somebody. And
yeah.
at the time when we were younger, we were just working just to save money and save it in our bank account. We weren't spending anything. And naturally, as time went, in high school, you just wake up and then you have a bunch of money saved up because you don't, like, for me at least, I didn't even know I could spend the money I was making. That's what my
Mhm.
parents were like, just keep it aside, save it, and then use it for university or whatever you need to in the
And you
future.
also
So
don't have a lot of expenses, right? To add on to that, like when you're in high school, early university, depending if you move out or not, but like you're living with your parents, food is covered. Like for a majority of the things, like you get provided. Like we were
yeah,
fortunate enough to get that provided, right?
Mhm.
yeah.
So obviously the money that we did make, like we had a very kind of strict mindset of like saving it. And like we didn't necessarily know what we were saving it for. We were just taught that you save your money and then you invest it later, right?
Mhm.
So
Yeah, just we were just naturally frugal, I guess. And then when we met, we both shared similar mindsets of like how we are with money, and we just naturally connected very quickly. And then that kind of led us to start our own kind of side hustle together, which was selling gym equipment. So the two of us, we were both, our first date was actually on the track, just like running
going on
and
a
doing
run.
workouts together. So we naturally vibed very well. So we started buying and selling gym equipment, ordering, liquidating from old gyms that were closing down during COVID, and then selling to other just people that were opening up home gyms. So that was a lucrative opportunity that we did together initially. And then we started to kind of learn about real estate, and her parents were both real estate agents, so that we were kind of bouncing ideas off of each other of how to, buy our first property. We knew that wealthy people acquire properties and own real estate, but we didn't know how to. So our first kind of like our first idea of this was potentially buying a pre-con, like a condo. Luckily, we didn't end up going down that route. We just decided that we will buy a cheap property in Ontario somewhere where we can afford an actual existing property. And then maybe, Clantha, you can touch on kind of how we started that.
Yeah, so we started doing like our research to see like what areas in Ontario we can invest on, and we kind of moved towards Windsor. For one, it was cheap at that time. It's still pretty reasonable, but also the fact that they have a university, the border's right there, like infrastructure of like where it could grow and people would come in and they would need to work like actual professionals. So that's what kind of drew us to Windsor, but also it was cheap. We were able to afford it. Our first property was just a single family house. It was completely turnkey, 4 bedrooms, 1.5 bath. And like our worst case scenario was at that time the interest rates were really low. So our worst case scenario was if our tenant doesn't pay or we don't get a tenant, our mortgage payment is like 800 bucks a month. We're working basically full time. We'll be able to pay that.
Mhm.
So we got a tenant in for 1900 and we were basically cash flowing, like they paid their own utilities and everything. So we're basically cash flowing $1,000 a month. And then at that point, the light kind of went on in our brain and we're like, holy shit, we got to keep doing this, right? Like we
Mhm.
need to grow from here. And then at that point, Jude found a mentor. Jude, if you want to touch base on that.
Yeah, then I guess after that we quickly realized, okay, we're making cash flow from one property. How do we acquire 30 more? That was our goal, like to buy 30 houses for whatever reason, because that can potentially retire us from our future job, which we weren't even working at the time. So, or working as a, professional or engineer at the
Mhm.
time. So naturally we were kind of just figuring out every single possible strategy and doing our research, educating ourselves. And then it was a year and a half until we bought our second and third property. But during that time, we spent a lot of time researching and trying to understand how we can go about buying our next one without having, number one, we spent all of our money on our first property. We literally didn't even have enough money to like insulate the attic. That was our next project within this property. But we just knew that, okay, we want to acquire more. And then we kind of started learning about the BRRRR strategy, how to add value. And then we started going to networking events. I was lucky that I met a mentor along the way who was basically buying 30 to 40 to 50 unit apartment buildings. And I was, all I did was I just said, let me work for you. Let me help you acquire more deals. Let me, cold call owners for you. Basically, let me just do whatever it takes to kind of like learn off of you and be kind of your right hand man. And then that's what I did. I decided to pause school, move out to London where his operations and buildings were, and then basically just run around and drive for dollars and find other owners interested in selling. And then I would make a small commission. And then in exchange, I would also be learning on how he acquires the deals, how he finances them, how he refinances them, how he adds value. Basically, the whole operations part of actually acquiring the property. And then from there, we decided to kind of acquire our own, and then we started scaling from there.
Yeah, we basically implemented what he was doing on a smaller scale. During that time that you took the year off, I basically got my real estate license. This was in our second year of our undergrad. I got my real estate license, kind of sharpening my skills and learning what I need to learn.
Mhm.
And then from there, we started with the multifamily kind of acquisition. So we bought a duplex and a triplex, which was the complete opposite of the single family house that we had bought. It had needles on the floor. Like, it was obviously a shock to us, but we were
Mhm.
kind of like, we braced ourselves because we saw what his mentor was doing. So from there, we scaled that to, we kept that for a year, did the whole burst strategy, pulled out our initial capital, and then we bought a fourplex and a sixplex. And from there, kind of just scaled our portfolio and like snowballed that within the last few years.
Okay, awesome. So I've got a couple questions for you. The first one is, how has the Windsor market been during this downturn? So some markets, like they've seen a huge decrease in values, and then also like tenant profiles. It's a little bit tougher to find good tenants and that sort of thing. What's that been like in Windsor?
I think when we first started, like after our first property, we actually didn't buy again in Windsor. We were buying in kind of tertiary markets outside. We found that during COVID and kind of the peak season, there wasn't actually that many good deals to go around, so we just kind of paused acquisitions there.
Mhm.
But generally speaking, it's actually a very strong market when you compare like rents for what
Yeah,
where Windsor is or like to where Toronto or even London is. Like
yeah,
it's not a huge drop in rent, but the values that you can buy apartment buildings for is actually like very attractive. So you can get in these deals at, like a very good price, but the rent to price ratio is a lot better than like London or
yeah.
Kitchener or Toronto or other markets that we've been in. So naturally we gravitate to kind of
Yeah.
the
I was
southwestern
actually
market.
looking at some rental ads in Toronto the other day just to see what like their one beds and two beds are going for in like apartment buildings. And it's crazy to see that it's like basically on par with what we're renting here in Windsor,
Yeah,
except the value in Toronto is a lot more compared to here, right? So
right.
it's, yeah.
And what about the quality of applications that you're seeing? Has that changed at all in the last 2 years, like with the downturn in the economy?
We've definitely had to like swift through tenant profiles a lot more in terms of like tenants, they are getting a little smarter when it comes to like faking documents and doing all these things, right? So it's like making sure that we're able to verify every single detail of the application, but
Mhm.
you do that regardless, right? Like before you put any tenant in there, you want to make sure that you go through their application with a fine-tooth comb to make sure that they're not going to end up in any situation that then you have to deal with later on, right? So,
I think
yeah,
if you're
like,
even comparing like 2 years ago to now, it's a
yeah,
complete different like even mentality or atmosphere or environment to like rent units because before there was a lineup at the door, there were, multiple applications. Now you have to really do good marketing. You have to be actually a good property manager. You have to, treat your tenants well and you have to kind of be on top of things when it comes to maintenance and management because now if you're not on top of things, then you're going to have a high turnover. You're going to have high vacancy. So just generally speaking, you have to be a good operator to really survive in this market, especially if you bought at the peak and you have to kind of sustain. You have to not lose control on management and operations. So that's something that we take very seriously. We always, even leasing is a big focus for us and most other people that are operating real estate now. You have to manage your vacancies and just make sure that you have a good leasing strategy and, just making sure that you're fully occupied or at least, a high occupancy at all
Mhm.
times.
Yeah. So do you guys have a property manager or are you filling your units
So
yourselves?
in Windsor, we self-manage, and then in Sarnia, we have a property management company
Cool.
that
Yeah,
we
like
work
it
with.
depends. So like, I think going forward, we're trying to kind of vertically integrate
Yeah.
like how we operate because we've had good property managers, we've had bad property managers. It's kind of based on area now. So like majority of our portfolio is in southwestern Ontario, so call it everything west of London or in and around London area. So we have two buildings in Sarnia that we kind of have a third party property manager for, and then everything else kind of going forward, I think we're just going to keep under our own wing and under our own oversight because this is our full time and it just makes sense to kind of be uh, kind of very hands-on.
Mhm.
And then as we grow, like our goal is to kind of bring somebody in full time for just day-to-day management. But when it comes to leasing, honestly, we don't even do the leasing ourselves, just in general. We rely on really good leasing agents that lease units way faster than we can. So we have great like help on the leasing side because if we were to do it on top of everything else, on top of the apartment building sales and other things that we're doing, it would just be, we would just leave units vacant for months and you have to be really hands-on with it. And even
And
if we're
for us, I feel like it also helps that, like, for example, in Windsor or like the buildings that we self-manage, even in London and stuff, like we have a superintendent that lives in the building. So when it comes to like day-to-day stuff that needs to be done, like if there's a plumbing leak or like if the floors need to be mopped, just like maintenance, like when it snows, like putting salt, doing all these things, like we have someone that lives in the building that kind of
Mhm.
oversees that. And then if there's any major issues or we need to get contractors in or do all of that, we organize it, but they're still there in
Right.
person, right? Like here in Windsor, we have our office, so we're not at the building 24/7, like managing it, right? But we have the superintendent that if anything happens, he'll just give us a call and let us know what's going on.
Mhm. Cool. And if when you do, so you said you have like a leasing manager. Do you guys oversee any applications that come in, or do you just give them full authority to,
No,
sign leases and that sort of thing?
yeah, no, we are fully in control in terms of like the leasing. So we have a leasing agent that basically does the showings, does the initial screening, but we get all the documents and it's kind of like our final say.
So what
yeah,
kind of
we
sorry, I was just gonna say, what kind of false documents have you seen? Well,
So I've seen credit reports and pay stubs falsified.
okay.
And in terms of like pay stubs, it's important. Like I tell all the investors that we work with, like search up the company, right? Like it's like they'll put a company logo and the company might not even exist. So like
Mhm.
search up the company and pull your own credit. So we use single key, and I found that it's really good in terms because it'll pull it from TransUnion and it'll pull the credit from Equifax.
Yeah.
So then that way you can see what's on both of those records and kind of compare it.
Hmm. Cool.
Yeah.
Um, Are there, so okay, I'm curious to know this, and I know you've probably covered this in the past, but how do you go from like these smaller projects to owning multiple buildings in a relatively short period of time?
I think the key was obviously I was fortunate to have the mentor, and he was very aggressive in terms of how he was scaling. And we saw like all around us there was people doing the same thing, but doing it kind of differently, where they weren't really in control of their operations. He was under the mindset of basically, first of all, scaling without investors. He was just using his own money, but recycling the capital kind of from building to building or deal to deal, but like just on a larger scale and multiple at the same time. But what I really took from that experience is that he was very creative in making his deals work because we're competing we're competing with many different operators, many different people acquiring multifamily. So it's just taking that twist of making the deals creative, like working before closing, vendor takebacks, just many different ways to make a deal cross the finish line that maybe other people would overlook a certain opportunity, but there were deals where, we made work because we were able to apply something creative that helps us on either turning over the building or just get saving us costs in terms of, financing or whatever it may be. There were different things that we applied to get into deals that maybe we didn't have the capital for, or we didn't, we weren't like, let's, for example, we were buying a sixplex as our third or fourth property, and normally people don't go all the way from like 2 units to 6 units. We just had the mindset of, okay, we want to grow and we want to creatively get into deals, and how can we actually plan for our exit, just based on just moving the numbers around. So that's kind of how we grew very quickly, and how we kind of manipulated the numbers to be able to
I
acquire
feel
good
like
deals.
one thing to add on to that too is also sitting down and like making sure that the seller or whoever listing agent, like they understand that both parties are on the same team. And like a lot of the buildings that obviously that we buy are like undervalued because the rents are lower or it needs a lot of work, right? So making sure that the seller understands that, hey, look, like I understand I want this amount, but it's not worth this amount right now. But if we work together, we can make it worth this amount in a year from now, or 18 months from now. So making sure that they understand why you're asking those terms and that it's like a positive situation overall.
Hmm. So can you give me an example? Let's say you were looking at like a $2 million building,
Mhm.
and so on a project like that, like if you went down the conventional route, you might need 30% down, and then you'd have
Yeah.
closing costs. And if there's CMHC financing, like there's additional fees there. So you could be in a project like this for, close to like 800,000, potentially
Yes.
more.
Yeah.
What would be some things that you can think of that you can do to reduce your capital, your initial capital?
So I think a few things to answer that question. First of all, like the way we look at every deal for just a high level is obviously price per door. Now that doesn't help like with actually, your debt servicing ratio, but that's a good way to kind of tell, okay, is this a deal worth, stepping forward and analyze further. So then once then we have to see where the current I guess situation where the rents are, where it could potentially be, how much upside there are on the rents. So that's number two. And then basically a kind of a criteria that most people should adopt is that the building on the like right now as is should more or less cover the debt or be a little bit of a surplus, and on top of that have some upside so that you can turn over units and then get that value out in a future refinance. So your question about kind of minimizing your capital to acquire the deal. Yes, it's very possible by, getting vendor takebacks or even a second mortgage or even, investors' money. But one thing that you have to make sure of is making sure that you have a straightforward path to get that money back or to pay whatever VTB or second mortgage or whatever you have off. So you have to like, and now doing, so-called cash for keys and, paying incentivizing tenants out is not always guaranteed. You have to like me and Clienta have a good eye for basically if we do a walkthrough, we start meeting tenants and inspecting the building. We have a good eye for kind of understanding where the low-lying fruits are and understanding how we can attract or uh, extract certain amount of value by potentially even adding units, or understanding that certain units are not clean or cluttered, or they're attracting bad people to the building like drug dealers. Like we've dealt with a lot of this stuff, so
Yeah.
we understand that there's a certain amount of turnover that we can get right away, or a certain amount of value that we can add right away with very low risk. So that's as long as we can kind of get in very low risk and then basically be able to increase the value to a certain amount just so that we can get our capital out. That's our goal, and also in a short amount of time. So that's kind of how we would structure things.
Okay, so just to clarify, I think like what I'm hearing you say is that it's not necessary, your goal isn't necessarily to enter the deal with as little capital as possible. It's more about how do we add value to this property and then refinance it, basically burr the building as quickly as we can.
Correct. Yeah.
Correct. And then obviously capital is another thing because we can't buy every deal. We're probably only
Yeah.
doing one or two at a time. So yes, so capital is very important. You want to like let's say a deal is a good cap rate, and you're entering at a good cap rate, or you're able to get it to a good cap rate, then essentially they're like you're able to get like typically we try to get vendor take back. That's like a normal thing that we would ask for just to try to minimize our capital in the acquisition because naturally we're going to spend money on capital
Turning
improvements
it
and
over, yeah.
upgrades to the property. So we have to kind of be careful of how to allocate money to certain deals. And yeah, that's kind of how we structure things. But it's not necessarily we want to get in zero down or like we bought our 20 unit or it was 19, we added one. We had to put, close to 30 or 35% down plus our renos and things because we only did that because it was a very good quality asset and we knew long term it's going to be a good property in our portfolio. So we were comfortable putting all that capital out. But now going forward, there's obviously better strategies we can kind of implement to, try to minimize the capital or even just avoid deals in general that need a bunch of capital or the rents are very low where we have to just put 50% down or, in that kind of in that range.
To add on to that too, I would say like we're pretty like for us, one, that's important. The other thing that's also important is how quickly can we turn this around, right? So we focus heavily, like the 20 unit that he was talking about, that was last year, and we already refied that and have moved that capital to the next project. But it's how quickly can, like, how, first of all, how many units do we actually need to turn around to break even or surplus? And then after that, like, how quickly can we do it? And is there a way that once we firm up, we can go ahead, go in and start talking to these tenants, right? So
Mhm.
we like to do that. We like to basically say, hey, it's a firm offer. You have your deposit. We have every intention on closing. This is a done deal, but let us go in there and speak to the tenants and just start having conversations and kind of just put the thought in their head that they might need to relocate or whatever, right? So that's one thing that we like to do as well. And then once we close, like it happens pretty quickly in terms of them leaving, renovating the units and like leasing it again.
Yeah. So with that 20 unit that you mentioned, was there anything there? So from what I understand, you were able to burr it within a year. Is that correct?
Yeah.
Yeah. So was there anything in that deal that was unexpected? Did you get like did everything go according to plan, or even on the refi, did you get the number you thought you would get? That sort of thing.
Yeah, I think like generally speaking, we were planning to one of the big value add components of this deal was adding that extra unit. So that was the thing that actually took the longest. That was like the bottleneck, I guess you could say,
It was the permits,
because
I
we
guess,
could
that took the
only
longest to get.
yeah, the permits that we weren't expecting. We thought, okay, it's going to take a month to get the permit and then construction, but it actually took like 6 or 7 months to get the permit, plus another 6 or 7 weeks to get the construction done and then leasing. That was one kind of not issue, but thing that we had to deal with just because of city. But the other thing was, I think more or less our plan was to kind of turn over a certain amount of units in the building. To date, I think out of 20 units, there's only two or three basically under $1,000. The rest are at
Yeah.
market, call it between 14 to 1700 range. So yeah, for the most part, we were able to turn over majority of the building. That's also because we were very hands-on. We were very kind of proactive with following up with people that were moving out or on their way out. And then in general, we had a few evictions.
Yeah.
I'm pretty sure you probably saw that video that went viral, but
Yeah.
we had a few evictions that took place. So just being proactive with our paralegal and
Yeah.
just in general with the tenants following up and just kind of being hands-on, just making sure that everything is happening is kind of simultaneously.
Yeah.
Yeah. And so the refi went as planned, like no unexpected, like did your appraisal go exactly how you thought, all that?
Yeah, for the most part, yes. What this was actually our very first CMHC deal. Before this, we weren't really relying on the CMHC financing. This is our first one because we found out like obviously CMHC is a good way to not only get more equity out, but also get good financing and good interest rates. So
Mhm.
our interest rate on this refinance was 3.75%. So generally speaking, if the cap rate is like let's say 6 and you're financing at 3.75, then you have a good like buffer for cash flow as long as you're maintaining occupancy. And we self-manage, so like there's a good healthy amount of cash flow that we're getting every month on this building. So that was a pleasant surprise to know that okay, like all of our properties in the past, they're all on 20 or 25-year amortizations with very high interest rates and very high DSCR minimums. So we were pleasantly surprised that we actually have a good quality property that's making a lot of cash flow now, and it's actually helping us on a monthly basis, and we kind of want to mimic that going forward.
Awesome.
Yeah.
Any tips for how you've been able to negotiate with certain tenants to, turn over some of these units?
Yeah, in terms of Well, it's dependent on whether they're paying or not, right? So if
Mhm.
they're non-paying tenants, I would say get a good paralegal and just stay consistent with it. Like for us, that's been like our number one with non-paying tenants is like giving them notice after notice, filing, staying on top of them, doing the hearings, doing all of that. In terms of other tenants that are paying that are like lower paying, I would say, is just honestly sitting down with them, having a conversation with them and figuring out if they were to get this surplus of funds, what could they use it for, right? Like a lot of these older people, like we had a 10 unit building that the entire building was tenanted with tenants when we bought it. And that was a huge risk that we took on. But we were able to go to every single unit and we helped each tenant basically move on to a better life because they were already like they were older and they were on their way to another home. So that kind of just gave them the boost that they needed.
Mhm.
So yeah, I would say just like instead of just like issuing this and that, just sitting down with them and seeing what their plan is. And in the 20 unit building, we still have some tenants that are there and like we're okay with them being there because they honestly love living there and like they're happy, right? So
Yeah,
it's just making sure that it's a win-win for both situations.
cool. And in terms of VTBs, because you guys kind of touched on that a little bit, what would be like what type of structures do you propose when you're going after certain properties? Are you trying to get a large VTB in first? Are you getting a smaller VTB in second and then getting CMHC financing in first? Like how does it work for you typically?
So I guess first of all, we would never go CMHC on the acquisition unless maybe it's like a unique type of property. But typically there's some sort of like call it like a bridge period where you're adding value, turning over units, and then taking it to then your exit. But when it comes to VTBs, like you always have to ask the question is, first of all, how long they've owned the building. Second of all, how much debt do they have on the building or against the building? Um, and then third, what type of owner are they? Are they an owner like us who is experienced and understands how to operate buildings, or are they a legacy owner that kind of like owned it by accident, or they bought it 20, 30, 40 years ago and they just own it now? And you kind of have to understand who's the owner, and then you can evaluate, okay, am I going to go in for first position financing or second position financing? So the goal ultimately for to get this VTB is to minimize your total costs in the deal. So you have to understand the situation first, and then second of all, then understand that, okay, if, for example, they have a mortgage of 50% or 40%, then naturally, if you're going to go in for first, then you're going to have to put in 50 or 40% down, which that's not what we're looking to do. So naturally, in that case, we would ask for a smaller second to support our first. And also another thing is that we try to not get interest on that VTB because we explain to the owners that there's a period where we're going to be putting lots of capital in the building and we're going to be bleeding every month, so we can't afford to pay you interest on this money. We're simply just getting this just to help us acquire your building so that we can add the value that it needs and then pay you out in a certain amount of time. So that's kind of
And
how
then
we go.
also, I guess, reassuring them, like, say, for example, we would do like an 18-month term, like telling them it's fully open and like our plan right now is to get it done as soon as possible. And if they're still like hesitant on the no interest, we say, okay, for like 8 months, we have no interest, and the rest of the term, it's like 7% or 8%, right? Or even like 10%, whatever. So then we tell them that, hey, look, for us, like, we want to try to finish it as quickly as possible so that we can pay you all your money back, and then if we don't, you're not losing because you're getting 8% interest on a monthly basis, right? So kind of showing them that regardless, it's going to work out for them. Either they get paid in full really quickly or they get interest after a certain amount of time.
Mhm. Yeah, I think you guys have really good knowledge about VTBs, and seems like your mentor taught you a lot. And I know that you guys were also a member of the same group, the Durham REI group. So can you tell me a little bit about like your relationship with Quentin and what you may have learned from him?
Yeah,
Yeah.
so I think I met Quentin before Jude actually. He came to like a coffee shop event in Mississauga, and that was my first interaction with him in person, but like I've been following him for the past couple of years, and like he obviously is big in the multifamily space, so looking up to that and seeing what he's doing.
Mhm.
And then I remember when I first spoke to him, I don't know if he remembered me, but then when he spoke to Jude, I was in the car with Jude, and he's like, "Wait, I remember her."
Yeah.
So that was my first interaction with him.
Cool.
Yeah, I know he's been a OG in the space. He's,
Yeah.
been acquiring buildings for a very long time. So he was another person that we looked up to, and we always used to kind of listen to his resources and podcasts early on. So, and he's also from the same community as us. He's also going as well. So
Hmm.
it's just another person to kind of like look up to who's also, similar background as us.
Yeah. 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 That's cool. All right. So are there any current projects that you can share with us? Anything cool that you guys are working on right now?
Yeah. So we last week we just acquired a 25 unit building, and this is again in southwestern Ontario. This one is a bit different because it's our first mixed use building, where it's the commercial tenants on the bottom and then residential tenants above. Maybe Clanta, you can touch on kind of the strategy and why we bought the building.
Yeah. So in terms of this building, basically, like he was saying, 25 units, our first kind of intro to mixed use. And when we were first looking at this deal, is actually crazy because like everyone says that you get great deals like off market, and like those are the where the best deals are made. But this deal was on the market, and then it initially expired, and we reached out to the sellers to see if we could make something work. And it was just the numbers for this deal, like it was a high cap rate, everything made sense, and the seller himself was looking to retire. So he owned it for over 20 years and he just wanted to retire, travel, not really interested in managing tenants. So we were able to come to a conclusion. We met him in person. He liked us, we liked him. We're like, okay, let's do a deal together. And then yeah, we made it work.
Yeah, I think originally we had it on our table for like let's say 7 or 8 months, and we just
Yeah.
didn't really look at it because it's mixed use, and we're all kind of we're looking for newer buildings, like nicer quality, bigger units, things like that. But we just ignored this for the longest time, and then one day I'm like, you know what? Let me run some numbers, and I was bored, and then let me see how the numbers are, and then I was like, wow, it's like a close to a 10% cap rate
Yeah.
on the acquisition. So we then okay, we're like, okay, how or like it was call it like 8 or 9, but then we got a better price, which made it like closer to 10.
Yeah.
So we said, okay, why are we not looking into this? Why are we not negotiating this? Let's get a deal done. And then naturally we sat down with the owner. He liked us. We were the exact type of avatar he was looking for and a buyer for the property. And then, we made a deal work. So now we just closed last week and now we're starting our kind of value add process and then,
Yeah.
normal kind of takeout process after that.
Awesome. Congrats. Yeah, I think you guys were telling me about this closing that you had because we were originally scheduled to record during your
Yeah,
closing.
it was a
Yeah.
busy week because we had
Yeah.
to onboard tenants and meet the people and whatnot and sign with the commercial units as well, long-term
Mhm.
leases. So yeah, we were doing all that last week.
So what's the plan with this property? Are you gonna add units? Are you trying to convert the commercial to residential? Just kind of the standard turnover, the residential units?
Yeah, so for the commercial units, there were actually two of the tenants that leases were expiring or like that were coming up for expiration. So we basically negotiated a better price for those. And like that's kind of the best time to do it because if it was the previous owner, they'd basically just say no to him, right? So because we were taking over, new management, they want to stay there. They want to make a good impression on whoever the new landlords are. So we were able to talk a price that's fair, but still live a little bit under market value because in Strathroy, and like we learned that in Strathroy that the commercial space is like pretty big. Like when it comes to like the downtown core,
Hmm.
like our our building has two like tattoo parlors, and right opposite there's another tattoo parlor. So it's like they're very like you see a lot of these spaces around.
Yeah.
So that was one strategy is increasing the commercial rent. And then the other one is what we usually do in terms of like the lower hanging fruits, kind of not targeting, don't want to use the word targeting, but just speaking to them, having conversations and seeing what can be done in
Yeah,
that
I
sense.
guess we were kind of bringing up the low-hanging fruits before. So there's quite a few smokers in the building that smoke
Yeah.
in the building. So, naturally we're going to put in rules in place and if they don't abide by the rules, we will be giving notices. We will, it's just interfering with the enjoyment of like other people's units, ourselves, and just have a process in place so that if they don't follow rules, then we're gonna have to, unfortunately, like yes, previous owner had his own process and his own rules, which has been like that for 20 or 30 years, but now new management is coming in. New management has their own rules, and this is a building. There's fire hazards. We have insurance. We have to, we have obligations too. So just putting certain things in place so that they understand that we're taking over. Some people will agree, some people will not, and the people that don't agree, then unfortunately, we have to
Mhm.
kind of go our separate ways. So
Yeah.
yeah, that's kind of
That's
what
the
we have
plan.
going on. And
And
then
then, yeah,
yeah,
the
in
plan
terms
is,
of
oh, go ahead.
no, I was just going to bring up the brokerage and how we're Clienta's very focused on the brokering side of things and brokering deals, and that's a big focus for last year and also this year. We have big goals in terms of how many we want to kind of meet more clients, more buyers and sellers, and then yeah, we Clienta's been taking kind of the lead on that end.
Yeah.
Yeah. Why don't you tell us? Because I know last year you had sent me a couple of deals that were off market. And then sure enough, within, I think it was like a month or two of you sending them to me, they went on the market. So I'm not sure how you're getting all these opportunities, but yeah, you can tell us a little bit about that.
Yeah, like I feel like that's kind of our little special power is like we'll send it to investors and then a couple months later they're like, "Oh, I saw this like a couple months ago from you guys."
Yeah.
So for us, honestly, it's just the networking aspect and like we have a huge list of all the sellers that we've contacted over the last couple of years and just staying in touch with them and following up with them, regardless if it's about their buildings or not, just sending them Christmas cards, keeping in touch with them, just having like different touch points where we have a conversation and see how things are going on in their life. Because 2 years ago, they might not have wanted to sell, but something could have happened in their family and now they need to sell, right?
Hmm.
So by staying top of mind, like they reach out to us whenever they need. So yeah, just contacting owners directly and whenever they
I
are
guess
ready, go ahead.
another thing is being a good resource because
Yeah.
legacy owners, they're not really in tune with new financing or new strategies to increase rents or whatnot. So just honestly, just providing value and not necessarily just saying, hey, I want to buy your building. Hey, let me broker your building, or hey, let me, just not being kind of annoying, which most people do. We want to actually be of value to them. People get calls, we even get calls of people trying to buy our buildings and whatnot. So it's like you want to be different than most people, and just being kind of what Cliente was saying, top of mind is, and being of value is super important.
Yeah. Awesome. So to end things off, I appreciate you guys sharing all this and congrats on your new building. What kind of services do you offer? Obviously, we just touched on that a little bit, but if you can share a little more, and then also what's the best way for anyone listening to get in touch with you?
So yeah, again, our company is called Fergo Group. We offer basically off-market value-add buildings, similar to how we're acquiring buildings. We have clients and buyers that are looking to acquire. So as long as we have some sort of kind of a criteria of people that are looking to buy buildings, we match up opportunities with certain people. And then we also offer sort of consulting services, not necessarily as we simply all we do is just find good opportunities for new buyers, and then we put all the pieces in place when it comes to management, contractors, leasing. We help new people that are looking to get into the space buy their first, call it sixplex or tenplex, or kind of their first value add building, and then we help them throughout the process when it comes to adding value. And we do this simply for free. All we do is we just charge a commission to the owner and on the sale, and that's how we kind of grow that end.
And then on the listing standpoint too, like if there's owners that are looking to sell their buildings, like being able to find them something off market, or if they want the highest and best price, listing it on the market for them and getting them the highest and best price.
Awesome. And then best way to reach you guys?
Yeah,
So
so
we're
our
very,
company's
go ahead.
Fergo Group. You can
Yeah.
reach us out on Instagram, or our personal Instagrams, Jude Gomes or Clienta Fernandez.
Awesome.
Yeah.
Yeah,
Anything else, guys, before we finish things off?
it,
Um,
all good. It's been a
I think we're all
pleasure. We,
good.
we
Yeah.
appreciate the time,
Been
and it was
good.
great
Yeah.
meeting you at Durham REI.
Yeah. Yeah. Thanks for doing this and all the best moving forward.
Of course. Thank you. You as well.
Thanks for listening to this episode of the Well Off Podcast. If you enjoy the show, then I'd really appreciate if you left us a review on iTunes and let us know your thoughts. In order for us to get a larger audience, it's really important to have reviews, so your support is extremely appreciated. And also, don't forget to share the podcast with your friends and family. Until next time, I'm George Almasri. Have a great day.